Picture the classic retail trader, sitting in a dark room, eyes locked on a dozen monitors, trying to decipher chart patterns in real time. In today's markets, relying on human reflexes to click a mouse and execute a trade is a consistent formula for losing capital. Your competition is no longer other people. You are up against custom-built code, executing directly alongside ultra-high-speed transaction logs. A human brain takes roughly a quarter of a second to process a visual cue. By the time that signal reaches your hand, an automated program has already executed thousands of decisions. Biological speed limits have permanently priced humans out of manual finance, leaving a vacuum for machines to fill. To bridge that speed gap, the first wave of modern traders moved their assets to centralized exchanges like Coinbase and Kraken. While those platforms operate faster than a human, they still rely on traditional server architectures that experience data choke points when network traffic spikes. To fix this, developers introduced app-specific Layer 1 blockchains. Networks like Hyperliquid minimize server latency. By processing information in parallel, they remove legacy latency spikes, allowing the network to process tens of thousands of updates every single second without dropping performance. Rather than hiding that activity on a private corporate server, this high-speed execution happens directly on a transparent, decentralized public ledger. By utilizing a decentralized on-chain order book, the system removes the need for a central corporate entity to facilitate trades between parties. These decentralized platforms are custom-built engines, engineered to operate with higher throughput than centralized legacy systems. Since humans cannot react fast enough to participate in this environment, we have to ask, what is actually operating this ledger? The operators are agentic infrastructure, autonomous software entities built to manage transactions on these high-speed networks. These agents differ from basic trading algorithms because they use AI to adapt to complex, shifting market conditions in real time. They autonomously manage risk profiles and optimize liquidity without a human operator. These systems rebalance asset pools at the edge of the network, reacting to price shifts faster than a human can perceive them. Manual risk management has been replaced by a self-sustaining autonomous state machine. Pairing agentic infrastructure with high-speed L1 blockchains creates a transparent financial engine designed to scale across massive transaction volumes without central oversight. This system has already proven its capability in the high-stakes market of crypto perpetual contracts. Crypto assets like Bitcoin and Ethereum provided the environment to prove this architecture could handle extreme volatility and volume. If autonomous code can successfully manage a digital token via a perpetual contract, that same logic can be applied to traditional real-world assets. This is the transition to 24/7 global macro. This autonomous infrastructure is currently integrating with legacy finance, applying these automated protocols to traditional asset classes across the globe.